Now let's look at the income statement. The income statement can also be referred to as the statement of operations, or the statement of profit and loss, which is sometimes shortened to P&L. When you think about all of the transactions that a company records during a period, you can see why it's necessary to have a statement that's dedicated just to the operations of the business. While in theory it could be possible to record everything on the balance sheet under retained earnings, we realize that really it requires its own statement to keep track of all of the income, all of the expenses, and all of the resulting profits or losses. Let's look at the income statement in more detail. The income statement starts at the top with revenues. Revenues can also be called sales or turnover. It represents the income that a company receives for selling goods or services. Below revenues, we have direct operating expenses, such as purchasing inventory. This line is often called cost of goods sold or cost of sales. This is the first expense line on the income statement. After deducting cost of goods sold from revenue, we arrive at our first subtotal on the income statement, referred to as gross profit. Gross profit is equal to revenue minus cost of goods sold. If we take the gross profit and divide it by the revenue, we calculate the gross profit margin. Next on the income statement come the indirect operating costs. These include things like research and development, administration, selling, and distribution. Several of these line items may be grouped into one, sometimes called selling, general, and administrative expenses, SG&A, or just general and administrative costs, G&A. If we take revenues and deduct the direct operating costs and then deduct the indirect operating costs, we arrive at the next subtotal, operating income. The terms profit or earnings can be used interchangeably with income. Operating income is often referred to as EBIT, which stands for EBIT, earnings before interest and taxes. Below the operating income line on the income statement, we can then deduct the cost of debt financing. This includes interest expense and bank charges. After deducting the cost of debt finance, there is often another subtotal for earnings before tax. Below that, taxes are deducted, and finally, we arrive at net income, the bottom line. Net income can also be called net earnings or net profit. This is the bottom line of the income statement, which then feeds into the retained earnings account on the balance sheet.